Hello dear students, welcome back. I am Vishwa Ahuja and we are studying accountancy. So as we have all heard that India is developing and it is going into the digitally payment country. So what is the meaning of digital payment? Digital payment simply means that to do the payments or to receive the amount on a digital mode. That simply means to pay the amount not by the cash but by other means. So what are those other means? So those other means are paying through UPI. As we have already seen that in the market, there are so many scanners of different companies where simply we have to scan and the other person receives the amount with no time. Is that okay? So that is the meaning of online payments. So the online payments can be done through NEFT. Next, it can be done by RTGS. Next, it can be done by UPI or the fund transfer. Or else the check can also be issued. That is also known as the online payment. Now, the question arises, if at all we are doing the digital payments, how will it help India? How will it remove the black money? So simply what happens is, whenever the goods are sold, if the person pays the amount through cash, so the person who is selling the goods might not be possible that he deposits the amount into the bank and he doesn't shows this in his books of accounts. So that's why it generates the black money. This leads to the generation of black money where the money is not getting deposited into the bank and it is not being accounted for into the business. Okay, so just to remove this, the government has urged all the persons that we should use the UPI. Now, the question arises, is UPI for free? Not at all. UPI is not at all free. But the government, just in order to remove the black money circulation, they have come up with the idea of UPI where they are doing the expenses for the transactions. For time being, the UPI payments are for free, but might be possible they would be chargeable in future. So, UPI is not at all free. Nowadays, there is one more thing upcoming that the payments can be done by UPI without having the internet. Yes, this is a facility which is being coming up that you can simply, you will be receiving a message where you can simply transfer the amount by just a message, by simply texting to the bank that yes, transfer this amount from my bank account to this person's mobile number. So it will be transferred. Now the question arises, what about the cash flows? Now we will be seeing what impact will it take on the cash flow statement. Now just remember, cash flow statement, it doesn't mean it is literally of the cash. It can also be done through the banking transactions as well. So cash flow is the statement which records all the inflows of cash and all the outflows of cash. Not only cash, but as well the banking transactions also. Okay, so it will not at all affect the cash flow statement because the cash flow statement has to record all the type of transactions, be it the online, be it the offline, that is the cash mode. Okay, so in a cash flow statement, there are three types of major activities. The first one is the operating activity. The second one is the investing activity. The third is the financing activity. These three are the activities, major activities in which we have to record the cash flows of different activities. Okay, so what is an operating activity? Operating activity simply means that all the transactions which relate to the day-to-day operations of the business are recorded in the operating activity. Like for example, if obviously it's a business, so we will be purchasing the goods, we will be selling the goods. So the cash paid to purchase the goods or else payments done for the expenses are just deducted from the cash flows in the operating activity. And the amount received, and when will we receive the amount? Only when the goods are sold or else when we earn the income. So all the amount which we receive, which is because of the business, which is the main core operations of the business, are simply recorded in the cash flow statement of operating activity. So this was a general theme of cash flow from operating activity. Now we will talk about the investing activity. Investing, as the word suggests, that investing means the amount which we invest in some of the assets. Exactly, this is the actual answer as well, where when we purchase the assets, the fixed assets, I'm talking about the non-current assets. Okay, so non-current assets are of two types. The first one is the tangible assets. The second is the intangible assets. So whenever we purchase the fixed assets or the tangible or intangible assets, obviously there is the outflow of cash. So whenever there is an outflow of cash, so we have to simply deduct it in the cash flow from investing activity. Now the question arises, when will be there the cash inflows as compared to the investing activity? So it will be only when we sell these assets. Okay, so whenever we receive the cash by selling the assets, so it will be a cash inflow, and whenever we will purchase the asset, so it will be known as the cash outflow. Apart from that, there are more items which appear in your investing activity. So what are those? So those are basically the items related to these assets. For example, we have a building. Now, since we have a building, obviously we might not use the building, and we might have given that building on rent. So the rent amount which we are earning out of that building is also the part of investing activity. Now the question arises, why is it an investing activity? Because our main work is not to give the building on rent, but to do the production work. If there is a company whose main business is to give the buildings on rent and to earn the rent only, so it will be a operating activity for that particular business. But usually our business is not of giving the building on rent and not earning the rent. So that's why it is termed as investing activity, because the amount which we are receiving from the rent is from the assets, and assets are ultimately the part of investing activity. Okay, now apart from that, suppose we have made a fixed deposit in the bank. Now the amount which we receive from the fixed deposit as an interest, that is also not our main core business, but it is your investing activities part. So these were the items which relate to the investing activity. Now let's come to the financing activity. So the finances, as we all know, finances simply relates to the money. Now in the accounting, finance simply means the amount which we have obtained for the business. That is, it can be, we might obtain the amount from the owners in the form of capital. Apart from that, the amount which we can take from the bank as a loan. So these are all the amounts which we take for the business, for the normal operations of our business. Okay, so whenever there will be an inflow of the cash because of taking a loan or else taking the amount from the owners, so it will be termed as the cash inflow in the financing activity. Now whenever we will repay the amount to the bank loan, and whenever we will redeem the debentures or the shares, then there will be an outflow of the cash in the financing activity. Now apart from these, there are some related items as well. So the question arises, what are the related items? Now just tell me one thing. If at all we are taking a loan from the bank, so will the bank give us this money for free? Obviously not. They will charge an interest. The interest amount, the interest expense which we are paying to the bank on the loan which we have taken, so that interest is a related item to the financing activity. So it will also be deducted from the financing activity. Okay, now apart from that, we also pay the dividends to the shareholders, the interest to the debenture holders. So these are also some of the outflows of cash when we talk about the financing activity. Now sometimes we also pay the premium on redemption of debentures or shares. That's again a cash flow. Apart from that, we also receive a premium at the time of issue of shares or debentures. That is basically your inflow of cash, which concerns to the financing activity. So these were the three major activities in your cash flow statement. Okay, now with this we have completed the full cash flow statement summary, and at the end of the cash flow statement you have to write down the net effect of all the three activities. That is, you have to write down the sum total of all the three activities, and after that we will add the opening balance of cash which was there in the starting of the year. So we will get at the end the closing cash available at the end of that particular year. Okay, I think now this concept is very much clear, which says that we are becoming digital. That doesn't mean it will affect the cash flow statement, because the cash flow statement has to deal with both the payments. It can be in the form of cash or it can be in the form of digital payments as well. As at the end, the amount which we add, the opening cash balances, it is not only the opening cash balances, it is basically the opening cash and cash equivalents. So we have to add all the cash and bank balances so that we can get at the end the closing availability of cash and bank. Okay, so this was the full summary of your cash flow statement. Thank you so much. Now, as we have completed the full summary of cash flow, so cash flow statements can be prepared in two ways. That is, there are two methods of preparing the cash flow statement. The first one is the direct method. The second one is the indirect method. The most followed method is the indirect method, where we start the cash flow statement from the net profit before tax. So question arises, why are we starting with net profit before tax? Because as we all know that the cash flow statements is prepared at the end of the year. That is, it is prepared after the preparation of financial statements. So when we have already prepared the financial statements, so we would have recorded all the expenses and incomes as well. Now, since all the expenses and incomes have been recorded, so we need to check that if at all in our income or expenses there are any non-cash or non-operating items, so we can easily and simply remove that so that we can have the expenses and income only on cash basis. So that's why, just in order to remove the double times doing the same thing, we simply follow the indirect method of recording of cash flow statement. Okay, so this is easy as well because we have done the main work already. Just now we have to just remove the non-operating expenses and incomes and non-cash expenses and incomes. Apart from that, there is also the thing which is basically the effects of current assets and current liabilities. Now, current assets are those assets which relate to the main operating activity. Why is it so? Because current asset, an example of current asset is the debtors. So who are debtors? To whom we have sold the goods on credit, from whom we need to take the amount. So debtors relate to the main core business operations because we have sold the goods. So our main business is to buy and sell the goods. Now the question arises, who are our creditors? So creditors are those from whom we have purchased the goods. So ultimately, the changes in the current assets and current liabilities are also incorporated in the cash flow from operating activity itself. So this was finally the end of the cash flow statement.